Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine for a moment a world where the brands you love truly get you. Not just, generic ads, but messages that feel crafted just for you.
Right, arriving at the perfect time.
Exactly. On the platform you actually use. Something that sparks a real connection, maybe solves a problem you didn't even know you had.
That kind of personal touch.
Well, that level of personal, digital engagement isn't just a fantasy anymore. It's the reality a company called Braze is actively building. They're really pushing the boundaries of customer relationships, especially now when, let's face it, true personalization is just essential.
It really is table stakes now for many brands.
So for you, thinking about this as an individual investor looking at this digital frontier, there's a really pivotal question here. Can Braze actually translate its impressive top-line growth, all that revenue, into sustained long-term profitability?
And crucially, what does that journey, that timeline actually look like?
Yeah, right. This isn't just about crunching the numbers. It's more of a strategic assessment, isn't it? Can Braze deliver enduring value, or will it stumble against some pretty intense competition?
That's the core question. And we're going to explore this thoroughly today.
We are. We'll dissect the opportunity, try to give you the clarity you need to understand it from, well, every angle.
What I find particularly compelling about Braze is their focus. It's not just about sending bulk messages. It's about orchestrating, meaningful human connections, but doing it at scale.
That's a great way to put it.
So our goal today is really to give you a comprehensive understanding, help you weigh the potential, which is considerable, against the very real challenges they face on that path to consistent long-term profit.
Okay, so to really get under the hood of Braze, we have to start with the people behind the vision, the leadership team.
The architects, yeah.
Exactly. And this isn't just any group of executives. It feels like a very thoughtfully put together blend of, let's say, deep tech foresight and seasoned operational know-how.
A good mix.
Right at the top, you have William Magnuson. He's a co-founder and the CEO. His technical background is impressive, honed at MIT, so he gets the tech side instinctively.
And that foundation was then layered with experience at Bridgewater Associates. That instilled a really data-driven mindset, didn't it?
It absolutely did. And you see that philosophy embedded throughout Braze now. Magnuson's vision is clearly laser-focused on AI-powered personalization.
You definitely see that.
And the recent acquisition of OfferFit, that just screams commitment to that vision. OfferFit is an AI decisioning company brought in specifically to, turbocharge campaign effectiveness for their clients.
A very strategic move. Then steering the financial side, you've got Isabel Winkles, the CFO.
Strong background there, too.
Very strong. Companies like Symantec, FireEye, she brings that critical financial discipline. And she's been instrumental, really, in moving Braze towards greater fiscal responsibility.
Didn't they hit their first non-GAAP profitable quarter recently?
They did, mid-2024. And just to clarify for everyone, non-GAAP basically means profitability measured without certain non-cash or one-time costs, giving a clearer view of their actual operational performance day to day.
Got it. And then there's the other co-founder.
Jonathan Hyman, yes, the CTO. He's the one overseeing that incredibly robust technical backbone of the platform, making sure it can scale.
Which is great.
Absolutely non-negotiable when you're handling the sheer volume of data and the complex needs of huge clients like Gap or Hugo Boss. You just can't afford downtime or slow performance.
And speaking of clients, that push for bigger enterprise deals seems clearer now, too, especially with Ed McDonnell coming in as Chief Revenue Officer in early 2025.
Yeah, bringing that Salesforce experience, that's a clear signal, isn't it? They're serious about accelerating growth with larger, more complex organizations.
Definitely. And you can't forget the board. People like Doug Pepper from IconicQ Capital. His expertise in guiding growth stage companies, well, that adds another layer of strategic support for Braze's scaling ambitions.
Right. So all these leaders, through decisions like, say, integrating Shopify's customer data for better e-commerce personalization, it all points to a focused strategy.
It feels very deliberate. Capture more market share, but also carefully balance that aggressive expansion with, keeping operations efficient.
That's a tough balancing act, for sure. But the team seems remarkably aligned on it.
It seems like more than just alignment, though. Doesn't it speak to a kind of cohesive strategy? Especially with the founders still so involved.
I think it does. That founder-led structure with both William Magnuson and Jonathan Hyman still deeply involved in strategy and tech fosters a unique unity.
That continuity must be significant.
It really is. Because founders often have that long-term view, right?
Yeah.
They prioritize sustainable growth over maybe quick short-term wins. And that naturally aligns their interests with yours as a long-term shareholder.
Magnuson's focus on AI, Hyman's work on scalability. It shows they're still committed to the original mission.
Absolutely. It's living proof. Now, this isn't some family-run shop, nor is it driven by one single, revolutionary figure. It's more about that steady, founder-led structure, providing a consistent vision.
And their own financial success is tied to the stock, right? That's in the public filings.
Precisely.
Yeah.
That further solidifies the alignment with individual investors. Now, some might argue maybe the absence of a, quote, transformative genius could limit their ability to disrupt quite as boldly as some competitors.
That's a potential counterpoint.
It is. But I think these founders' steady, guiding hands suggest a strong potential for consistent, long-term outperformance, which many investors prefer over high-risk, high-reward bets.
That makes sense. That deep continuity, that shared vision, it feels vital, especially when you consider their actual mission statement.
Which is very clear.
It is. Empower brands to be absolutely engaging. It's not just a tagline, is it? It feels like a strategic imperative. Foster meaningful connections through deep, data-driven personalization.
And their overarching vision, it's nothing less than dominating the entire customer engagement platform market. They want to do that by expertly leveraging AI and that seamless cross-channel orchestration.
And the company culture seems to reflect that ambition, too. Thriving on agility, continuous innovation.
Yeah, encouraging employees to iterate, adapt quickly.
You see it in action, don't you? They integrated new features like WhatsApp Commerce pretty fast, making it available back in 2025. Shows they're responsive.
Very responsive to market needs. And beyond just features, the leadership cultivates a genuinely data-centric environment. All teams aligned around key metrics. Customer retention, conversion rates, that kind of thing.
Are there examples of that paying off?
Definitely. Take Viber, the messaging app. They boosted their conversions by a massive 50% just by using Braze's analytics to fine-tune their campaigns.
Wow, 50%.
Yeah. So this dynamic culture really supports their ambition to redefine how brands talk to consumers globally. The big challenge, though.
Maintaining it as they scale.
Exactly. Maintaining that deep alignment, that agile spirit, as they continue this rapid scaling that will be absolutely critical to keeping their competitive edge against the bigger, maybe slower-moving players. It's that constant balancing act.
Speaking of scaling and growth, let's trace Braze's journey. Where did it all start?
It began back in 2011, actually, as a company called AppBoy.
Right, AppBoy.
The co-founders, Magnuson Hyman and Mark Kermedzian, they shared this really forward-thinking vision. Bring together mobile app messaging, analytics, user support, all into one unified platform.
They saw an early opportunity there.
They really did, helping brands harness real-time customer data to create genuinely personalized engagement. That was pretty revolutionary back in 2011.
And then came the rebrand.
Yes, a significant milestone in 2017. They deliberately rebranded as Braze. And it was more than just a name change. It was a clear signal of their expanded focus, moving beyond just mobile.
To embrace that broader cross-channel strategy, email, web, everything.
Exactly. It marked a fundamental shift in their market approach and what they could offer.
Then came the IPO.
Late 2021. That was pivotal. Raised substantial capital, which directly fueled their ambitious global expansion plans.
And since then, the customer base has grown steadily.
Oh, yes. Up to an impressive 1,770 brands worldwide now, including household names like ELF Beauty or Gymshark.
And the revenue?
Steep trajectory. Climbed from $150 million back in 2020 to a substantial $593.4 million in fiscal year 2025.
That's a big jump. What's the year-over-year growth on that?
That represents a robust 26% year-over-year increase. Strong momentum there.
Acquisitions played a part too, right? You mentioned OfferFit earlier.
They did. OfferFit in 2025 for $325 million. That wasn't just spending money. It really highlights Braze's proactive ability to adapt to market demands, especially that accelerating shift towards AI-driven solutions in marketing.
Okay, so impressive revenue growth, strong customer retention, that 117% dollar-based net retention rate in 2024 is key.
Meaning existing customers are spending 17% more on average. Very healthy sign.
But profitability on a GAAP basis, the standard accounting measure, that's still elusive.
That's correct. GAAP profitability, after all expenses including stock-based compensation and amortization, hasn't been achieved yet. And that's a key area we absolutely need to dive into.
Okay, let's do that. Let's try and demystify the business model itself, because you said at its core, it's pretty straightforward.
It really is.
Yeah.
Braze provides a cloud-based platform software delivered over the internet that empowers brands to engage with their customers. How? Through highly personalized cross-channel messaging.
Emails, push notifications, in-app messages.
Exactly. All meticulously tailored to what they know about individual customer behavior in real time.
Give us that coffee shop analogy again.
Right. Imagine your favorite coffee shop instantly knowing you always grab a latte on Fridays. And just as you're walking nearby, boom, you get a discount offer on your phone for that latte.
That's the kind of magic Braze delivers.
Precisely. And it's all powered by real-time customer data flowing into the platform, combined with sophisticated artificial intelligence making sense of it all.
Okay, so the core idea is simple, but the tech behind it must be complex. Features like Canvas and Sage AI.
Right. The technical intricacies are definitely there. Canvas lets brands visually map out and automate these really complex, multi-step customer journeys. Think flowcharts, but for personalized marketing.
And Sage AI.
That's their predictive analytics engine. It anticipates customer needs and behaviors, helping brands be proactive rather than reactive.
So while understanding the deep tech might require some expertise,
For you as an investor, the fundamental concept is clear. Braze helps brands like Overstock turn raw customer data into actual revenue
oh,
by significantly boosting customer loyalty and engagement.
you don't necessarily need to understand the specifics of their APIs, those behind-the-scenes connectors.
Or their SDKs, the toolkits for app developers.
Right. Just know that APIs let different software talk to each other, and SDKs let developers easily build Braze features into mobile apps. The high-level value proposition is what matters most.
Making marketing smarter, more effective, more personal.
And that value proposition is really what helps Braze stand out, right? And in what seems like a very crowded market.
It does. Their model distinguishes itself because it seamlessly integrates every crucial step: data collection, customer segmentation, campaign orchestration, taking action, all in one single unified platform.
Which is different from competitors.
Significantly different from many who offer fragmented solutions. Brands often have to stitch together multiple tools, which can be complex, expensive, and frankly frustrating. Braze aims to avoid that pain.
And you mentioned a passion driving them.
It feels like it. A genuine passion for making customer interactions feel human, not robotic. And they consistently excel at that real-time personalization piece.
Okay, so what fuels the engine? How do they actually make money?
Primarily, it's a subscription-based revenue model. Brands pay a recurring fee to use the platform.
And that scales.
It scales intelligently. As a client's engagement grows, maybe they reach more customers, send more messages, use more features, their subscription fee typically increases. So Braze's revenue grows alongside its client success.
Can you give an example of the impact?
Sure. TaxFix, the tax software company,
Yeah.
they use Braze to dramatically improve their email deliverability and relevance. The result, an impressive 69.3% email open rate. That's huge for email marketing.
Wow, that shows tangible value.
Exactly. This unified approach, combined with their advanced AI, positions Braze right at that interesting intersection of innovation, specialized expertise, and hopefully for them, substantial profitability potential down the line.
But that profitability score you mentioned, 26 out of 100 from Alpha Spread.
Right. That clearly signals there's still considerable room for improvement on the profit front. The journey isn't over.
Okay, so how does Braze actually reach its customers with this platform?
They operate a direct-to-business SaaS model. Again, SaaS, software as a service. You subscribe online.
And who are they targeting?
Specifically marketing departments. Across a diverse range of industries, retail, finance, media, you name it.
Is it mainly large companies?
Their dedicated sales team, now led by Ed McDonald, definitely puts a strong emphasis on acquiring and nurturing those large enterprise clients, the big fish.
But there's something for smaller businesses too.
Yes, they have a convenient self-service option. That caters efficiently to the needs of smaller businesses who might not need or want that high-touch enterprise sales process.
And being cloud-based helps with reach.
Absolutely. It enables seamless global scalability. Clients anywhere can access the tools instantly through a web browser or via those mobile SDKs we mentioned.
And partnerships, you mentioned Shopify.
Partnerships are key. That 2025 Shopify integration is a perfect example. It significantly enhances distribution by embedding Braze's tools directly into that huge e-commerce ecosystem. Makes it super easy for Shopify merchants to use Braze.
That sounds like a smart strategy.
It's proving effective. Look at Upday, the news aggregator. They use Braze's intelligent push notifications to re-engage over 500,000 lapsed users, 528,000 to be exact. That boosts Upday's engagement and Braze's reach.
What investors really like, though, is predictability. How does the model stack up there?
That's one of its biggest strengths. The subscription model generates highly predictable revenue streams.
What percentage comes from recurring contracts?
Public filings show it's consistently between 80% and 90%. That's a very high proportion.
That provides stability.
Huge stability. It comes from long-term agreements with key clients, like Hugo Boss, who really depend on Braze for their critical, ongoing marketing campaigns. Imagine knowing 80–90% of your revenue is likely coming in next year. That's powerful.
And the pricing scales, you said?
Right, a tiered structure. It scales with the volume of customer interactions. So as clients use Braze more, send more messages, manage more customer profiles, their fee increases, and Braze's revenue naturally grows.
Which helped drive that $593.4 million in FY25 revenue.
Exactly. That 26% year-over-year increase came from both signing up new customers and getting existing customers to renew and often expand their usage.
So that built-in predictability is a nice cushion against market ups and downs.
It definitely is. But, and this is important, its sustained success hinges entirely on keeping those customer retention rates high. If customers start leaving, that predictability erodes quickly.
Right. Let's shift from the how to the what. The products and services themselves, the engagement engine.
Okay. The primary offering is that comprehensive customer engagement platform. It's designed as an end-to-end system, integrating everything from pulling in raw data
To segmenting customers precisely, orchestrating campaigns intelligently, personalizing messages deeply, and then analyzing the results.
the whole life cycle.
And within that platform, what are the standout features? You mentioned Canvas and Sage AI again.
Those are definitely key. Canvas is that visual builder for designing and automating complex multi-step customer journeys. Think of mapping out the entire personalized experience.
Like a marketing workflow designer.
Exactly. And Sage AI provides those predictive insights, anticipating customer needs and behaviors, allowing brands to be proactive and highly relevant.
Plus the actual communication tools.
A full suite. Robust email capabilities, effective push notifications, and increasingly important WhatsApp messaging features, reflecting how people communicate now.
Has it achieved product market fit? The numbers suggest yes.
Strongly suggest yes. Those 7,770 global customers, that 117% dollar-based net retention rate in 2024, that's powerful evidence. Customers aren't just staying, they're investing more in the platform year after year.
What about recent innovations? Keeping up with the market.
Their responsiveness is striking. Recent launches include WhatsApp commerce capabilities and those pre-built Shopify integrated templates. Both came out in 2025.
And are they showing results?
Demonstrably boosting conversion rates for clients like Gymshark. Real-world impact.
And looking ahead, what's on the roadmap?
Even deeper AI integration, expanded e-commerce features, things like dynamic product messages that adapt automatically to individual customer preferences in real time.
Are they sticking purely to SaaS? No crypto or anything unusual?
Pure SaaS focus. No unique financial products or distractions like that. They're doubling down on their core competency.
Which signals what?
A profound commitment to evolving with market demands, consistently strengthening their value proposition for brands and therefore their long-term potential for investors like you.
Okay, let's talk operations. Where is Braze actually located and how is it structured?
Headquarters are right here in New York City, but their operations are truly global. Strategic offices in London, Singapore, San Francisco.
Why the spread?
It's essential for supporting that large customer base, 1,770 clients across 18 countries. You need local presence.
So New York is the hub.
Central hub for core R&D executive functions. Then London and Singapore focus more on regional sales and customer support, providing that localized service.
What about physical infrastructure? Do they own buildings?
No, they lease their offices. That's detailed in public filings. It gives them flexibility as they scale, easier to grow or shrink space without huge capital investment.
And data centers.
A significant portion of their data processing is outsourced to major cloud providers, especially Amazon Web Services or AWS.
Pros and cons of that.
Pro, cost efficiency, massive scalability, a degree of dependency risk. But that risk is heavily mitigated by the global redundancy built into services like AWS. They have backups for their backups.
So they're not vertically integrated? They don't own the whole stack?
Correct. They consciously rely on cloud infrastructure from AWS and others, and strategic partnerships like Shopify for distribution.
What's the advantage of that lean model?
Minimizes capital expenditure. They don't have to build data centers. But it does expose them to potential third-party risks, like an AWS outage, though rare.
How does that compare to, say, Salesforce?
Salesforce also heavily leverages cloud providers. Braze's deliberate lack of its own proprietary infrastructure limits direct control, maybe, but significantly boosts their agility and market responsiveness.
Like the Shopify integration.
Perfect example. Seamless data syncing improves the customer experience dramatically without Braze needing to build or own the entire e-commerce tech stack itself. It's a strategic choice focusing on their core value-add engagement.
Okay, let's dive into the competitive landscape. How does Braze stack up?
It operates in a highly competitive SaaS market. Definitely not a monopoly or even an oligopoly. Lots of players.
Big names.
Formidable rivals. Salesforce, HubSpot, Amplitude, giants in this space.
So Braze's market share is still relatively small.
Modest, yes, but it's steadily expanding. Serving 1,770 customers is significant, but it pales compared to Salesforce's overall CRM dominance, for instance.
Does the market fragmentation help or hurt Braze?
Paradoxically, it kind of helps protect their potential profitability. It allows them to carve out that distinct, valuable niche in real-time cross-channel engagement.
But the intense competition puts constant pressure on margins.
Exactly. It's a double-edged sword.
Do they benefit from economies of scale?
Inherently, yes. As their platform serves more customers, adding clients like ELF Beauty, the incremental cost to serve each additional customer is minimal.
Which should improve margins over time.
Naturally. But you have to remember, smaller, agile competitors, maybe like Sprinkler in certain areas, can still compete effectively.
Yeah.
So the scale advantage isn't absolute. It doesn't guarantee dominance.
What about network effects? Does the platform get better as more people use it?
Yes, but it's limited compared to, say, a social network. The value does grow as more brands join. Why? Better data benchmarking. Richer insights for everyone.
Like the Viber example.
Exactly. Viber's 50% conversion lift using Braze Analytics shows how collective user data enhances the platform's value. But it's not exponential in the way a social platform grows, where each new user directly adds value to other users.
How does Braze strategically differentiate itself then?
Primarily through that truly unified platform. It's a stark contrast to competitors offering fragmented tools needing complex integration. That's a major pain point they solve.
And the OfferFit acquisition.
That further strengthens their differentiation in AI-driven personalization. It adds a sophisticated capability that rivals will find hard to replicate quickly or effectively.
Does that resonate with clients?
Deeply. Especially clients like Gap, who prioritize that seamless, cohesive customer engagement experience. They want things to just work.
Let's talk about customer stickiness. Is it hard for clients to leave Braze?
Very much so. The platform benefits from high switching costs. Meaning migrating all that extensive customer data, all those complex marketing workflows you've built in Braze over to a different platform is difficult, costly, and risky.
Can you give an example?
Hugo Boss. Their deep reliance on Braze's Canvas feature for managing intricate global customer journeys creates huge stickiness. They're not likely to rip that out easily. And that protects Braze's recurring revenue.
What about the brand reputation?
Strong. Specifically among marketing professionals, built on reliability and continuous innovation.
Not an emotional consumer brand, though.
No, it commands loyalty through performance and results. Like Overstock, seeing high engagement rates using the platform.
Do they have pricing power? Can they charge a premium?
Moderate pricing power. It's definitely influenced and constrained by those competitive pressures. They can't just name their price.
What about unique resources? Things only Braze has.
Several compelling ones. Their proprietary Sage AI technology. Those strategic partnerships, especially Shopify. Their talent pool, including leaders poached from places like Salesforce, is a significant draw, though perhaps not entirely unrivaled in the tech industry. Patents on their data orchestration processes also add to their competitive moat.
And operational advantages. Process efficiency.
Their agile development process stands out. Rapid feature rollouts, like WhatsApp Commerce. Many competitors struggle to match that speed. It gives them a quality and timeliness advantage.
Sage AI and Canvas, are they truly superior tech?
They are proprietary and offer measurable advantages in personalization and orchestration. Maybe not literally 10 times better than every single rival feature, but demonstrably better in many cases. TaxFix getting that 69.3% email open rate. That speaks volumes.
Was their market entry timing lucky or smart?
Probably a bit of both, but definitely advantageous. Founding in 2011, perfectly aligned with the rise of mobile and data-driven marketing.
Gave them a first-mover advantage.
A significant one in cross-channel customer engagement. That powerfully fueled their growth to nearly $600 million in revenue. They helped shape the market early on.
And their speed of execution now. Launching features, integrating OfferFit.
Impressive. Consistently outpaces many competitors, which discourages direct imitation. Integrating OfferFit's AI in just months, not years. That exemplifies rapid, effective execution.
Does their global reach and industry focus help too?
Yes. That global reach, combined with developing specific solutions for sectors like retail and finance, provides a tailored competitive edge, makes them more appealing to diverse clients worldwide.
Okay, so they have a strong position. How do they plan to unlock future growth? What's the strategy?
It's multifaceted. Three key areas, really. First, market penetration. Digging deeper into existing core verticals like retail, finance, getting more business from current segments.
Second,
Market development, targeting entry into new geographic regions, particularly looking at fast-growing markets in Asia.
and third,
Aggressive product development, continuing to enhance those AI and e-commerce features, keeping the platform cutting edge.
and acquisitions and partnerships are central to that.
Absolutely. OfferFit and Shopify are seen as primary drivers. Enhancing AI, extending reach into that massive e-commerce landscape.
Is the growth potential significant?
Considerable, yes. They can target entirely new industries, maybe healthcare down the line, keep launching innovative AI products, and pursue more strategic acquisitions.
The OfferFit deals show they're willing to buy growth.
Clearly indicates an appetite for M&A, though you always have to acknowledge the integration risks merging companies smoothly is never guaranteed.
But past growth suggests they can execute.
That 26% revenue growth in 2025, despite their size, strongly suggests robust, sustained growth potential moving forward.
How broad are the applications for their platform? Is it just retail?
Oh no, very broad. Retail, media, finance, hospitality, many sectors benefit. And its scalability is boosted by being cloud-based.
That e-commerce focus with Shopify opens up big markets.
Substantial new markets. However, it's worth remembering that highly specialized niche competitors could potentially challenge them within specific, narrow industry verticals. They might know one sector even better.
What's the size of the overall market they're playing in? The total addressable market, or TAM?
Estimated at a really substantial $30 billion. That covers the whole customer engagement software sector for their core industries like retail, finance, media.
And Braze's current share.
With roughly $600 million in revenue, they capture a relatively small but rapidly growing slice of that $30 billion pie.
Is the market itself growing?
Yes, industry analysts project impressive 20-25% annual growth for this market segment through 2030. That indicates a significant long-term tailwind for Braze. Plenty of room to grow.
So, summarizing the key growth catalysts.
Okay, number one, relentless focus on AI-driven personalization, boosted by OfferFit. Two, strategic expansion into new geographies like Asia and new sectors like healthcare. Three, impactful partnerships, especially Shopify and WhatsApp. And four, consistently high customer retention, that 117% net retention rate, keeping the base solid and growing.
All right, let's pivot to the flip side. Risk, resilience, and longevity. How durable is this business?
Let's look at potential weaknesses. Their reliance on AWS for cloud infrastructure is a single point of dependency risk.
But mitigated how?
Mitigated significantly by AWS's own massive global redundancy and distributed operations. Plus, partnerships like Shopify help diversify their distribution, reducing reliance solely on direct sales.
What about customer concentration? Are they too reliant on a few big clients?
Actually, no. That diverse base of 1,770 customers across various sectors effectively reduces concentration risk. No single client dominates their revenue. That enhances financial stability.
Could their competitive advantages, their moat, erode over time?
It's possible. In a dynamic market, competitors like Salesforce could enhance their own tools and catch up. Also, broader tech shifts, especially towards more privacy-focused platforms, pose a potential threat to any data-driven model like Braze's.
But you mentioned they're anti-fragile. They adapt well.
They exhibit strong characteristics of that. They don't just withstand stress, they seem to adapt and even strengthen. Integrating consent features for privacy rules is one example.
Launching WhatsApp commerce quickly is another.
Exactly. That agility strengthens their position during market shifts or changes in consumer behavior. They can pivot.
So looking long-term, are they well-positioned?
Exceptionally well-positioned to capitalize on major secular trends. AI adoption, e-commerce growth, These aren't going away.
Their core products should remain relevant.
Highly likely. An estimated 80% probability of sustained demand over the next decade, driven by that enduring need for personalized customer experiences.
Could they weather a recession?
Their predictable revenue model suggests they could, perhaps better than companies reliant on one-off sales, though margin pressures would likely intensify in a downturn.
What are the main obstacles to their continued growth? The
Yeah.
key risks?
Okay, main risks. 1, potential market saturation in their core verticals eventually. 2, aggressive pricing from competitors trying to steal share. 3, unforeseen regulatory changes around data privacy. That's a big one that could significantly impact their model.
Are there known unknowns and unknown unknowns?
Yes. Known unknowns include the full impact of future privacy laws or the exact pace of competitor innovation. Unknown unknowns could be truly disruptive new tech we can't even imagine yet, or major geopolitical events impacting cloud providers globally. Black swan events.
How does the broader macroeconomic picture affect Braze? Interest rates, for example.
Rising rates increase borrowing costs, but Braze has minimal debt, so direct exposure is low. Plus, that strong cash position of $500 million as of 2025 provides a huge cushion.
Any indirect impact?
Potentially. Higher rates could cause their clients to tighten marketing budgets, which could slow Braze's revenue growth.
What about global trade? Does that matter for a software company?
Less directly than for manufacturing. Trade tensions could hypothetically disrupt cloud providers like AWS, but Braze itself is largely insulated from physical supply chain risks. Their expansion into Asia actually benefits from stable trade. Can squeeze client budgets, potentially leading to cuts in SaaS spending. However, Braze has high-value clients like Hugo Boss who are generally less sensitive. Smaller clients might cut back, though, pressuring margins.
And specific regulatory risks just for Braze?
Data privacy rules like GDPR are unique and ongoing. They require continuous investment in compliance, increasing operational costs.
Yeah.
But again, their global footprint offers some mitigation against shocks hitting just one region.
Okay, let's get into the current financial health. The numbers.
Right. Key metrics. Fiscal year 2025 revenue, $593.4 million, up 26% year over year. Strong growth from new clients and renewals.
More recently.
First quarter of fiscal 2026 saw $162.1 million revenue, up 19.6%. Still growing, though slightly slower. Gross margin is strong, 68%. That's typical of an efficient SaaS model. Cost of goods sold is low, but operating margin is negative 15%.
Why so low?
Significant ongoing investments in R&D and sales and marketing. They're spending heavily to capture market share. Net margin after everything is also negative 20%. AlphaSpread's profitability score reflects this. Only 26 out of 100.
What about that rule of 40% for SaaS companies, growth rate plus operating margin?
Braze currently stands at 11%. That's 26% revenue growth minus 15% operating margin. It's below the 40% threshold many investors look for, suggesting the balance between growth and profitability still needs improvement.
Return on invested capital, ROIC.
Estimated at negative 10%, reflects the current losses. But the trend is improving, especially with that non-GAAP profitability hit in Q2 2024. Things are moving the right way.
How's their balance sheet? Cash and debt.
Strong liquidity. Current ratio is 2.5, plenty of short-term assets to cover liabilities. And debt to equity is very low at 0.1, according to NASDAQ data. Healthy, flexible financial position.
Free cash flow. Are they burning cash?
Currently negative free cash flow. Yes, they are burning cash. But the trend is clearly improving. Q3 2025 showed a 10% reduction in cash burn year over year. That's crucial moving towards self-sustainability.
And those industry metrics again?
Dollar-based net retention at 117%, customer count at 1,770. Both highlight sticky revenue and consistent expansion.
How does this compare to peers, like Sprinkler or Amplitude?
Okay, revenue growth, 26%, beats Sprinkler, 15%, but lags Amplitude, 30%. Gross margins, 68%, is competitive with Salesforce, 70%. But those negative operating margins trail HubSpot's positive 5%. Braze is clearly still in heavy investment mode.
But the low debt gives them flexibility.
More financial flexibility than many competitors, yes.
Yeah.
More options.
So summarizing the financial trends.
Revenue growth rate has decelerated slightly from 33% in 2024 to 26% in 2025. That's partly competition, partly just the law of large numbers. But encouragingly, margins are improving with scale. Non-GAAP profit achieved. Cash burn reducing. The trajectory towards full GAAP profitability by maybe 2027 seems plausible based on these trends.
Let's talk recent news and what investors are saying. Q1 2026 results came out in June.
June 5th, 2025, showed that 19.6% revenue growth. Also gave more details on the Offred acquisition, highlighting the AI boost, and the appointment of Ed McDonald as CRO signals that intensified push for enterprise sales.
What should investors watch for next?
Definitely the Q2 2020 sales results, expected around September 2025. Look for updates on OfferFit integration progress and, critically, those trends in profit margins and cash burn.
What's the buzz among investors on platforms like X?
Seeing growing optimism, actually. Posts from accounts like @Isbeth at Kimmel Moore reflect excitement about the AI pivot. Mizuho issued an outperform rating, calling FY26 a potential turning point for profitability.
So overall sentiment is positive.
Ranges from neutral to positive. But concerns remain. Valuation is one Morningstar suggesting that 599% premium raises eyebrows, and potential delays in hitting full profitability. Competition from Salesforce is a recurring theme too.
So the narrative is
High-growth SaaS company, navigating the tricky path to sustainable profit. Lots of potential, but challenges remain.
okay, valuation. This is critical for you, the individual investor. Is Braze overpriced or a bargain right now?
At $28.88 per share, as of July 30, 2025, it trades at a noticeable premium based on some metrics. That forward PE ratio of 60 times is well above the SaaS industry average of 40.
And the stock price itself?
$28.88. That's currently below its 200-day moving average of $35.44, which suggests a recent bearish trend, some selling pressure.
Remind us about the margin of safety. Why is it important here?
It's crucial. It's the discount between the market price and your estimate of the stock's true intrinsic value. Buying Braze with, say, a 20-30% margin of safety provides a buffer against volatility, or if your valuation is slightly off, especially vital in a competitive market like SaaS.
Valuation isn't just theory, then.
Not at all. It's practical. Helps you avoid overpaying for hype or missing a genuinely undervalued gem. For Braze, it's about balancing that exciting growth against the profitability risks.
Yeah.
Is $28.88 a fair price for its future potential?
How can we estimate that intrinsic value? Discounted cash flow, DCF.
That's one way. If we make some assumptions, say 20% revenue growth for 5 years, tapering to 5% after that, use a 10% discount rate, we can project free cash flow turning positive in 2027, maybe around $50 million.
And what intrinsic value does that suggest?
Under those assumptions, roughly $35 per share, which implies the current market price around $29 offers a slight discount to that calculated fundamental worth.
What about relative valuation compared to peers?
Price to sales ratio is 8 times, higher than Sprinkler, 5x, lower than Amplitude, 10x. So kind of in the middle there. That high forward PE of 60 definitely reflects high growth expectations baked in, raising those overvaluation concerns for some.
What are Wall Street analysts saying, their price targets?
The average analyst price target is around $45.90. Some are even projecting highs up to $71.40, according to Alpha Spread. So analysts covering the stock are generally more bullish than the current market price suggests, and no crypto valuation needed, they hold none.
Okay, let's lay out the competing arguments, the bear case against Braze.
Bears highlight the negative net margins, negative 20%. That high valuation premium Morningstar flagged. They worry intense competition from Salesforce, HubSpot could erode market share. And evolving privacy rules are a constant threat.
The slowing growth rate feeds that bear case too.
Yes, decelerating from 33% to 26%. Plus those negative technical momentum indicators suggest downside risk. Maybe the stock heads towards $20.
Now, the bull case. Why buy Braze?
Bulls point to the robust 26% growth, that sticky 117% net retention, strategic AI investments like OfferFit positioning them for leadership. Mizuho's outperform rating, that average analyst target near $46, reflects confidence in profitability by FY26.
Partnerships and expansion are key bull points too.
Definitely. Shopify, global expansion, strong catalyst for scale. Bulls see Braze becoming a $50 plus stock if margins improve as hoped.
Which thesis seems more probable right now?
Weighing everything, the bull thesis feels more likely. Why? Sticky revenue model, real differentiation through AI, strong focus on enterprise clients.
But delays in hitting profitability could temper the upside.
Absolutely. That's the key risk to the bull case. So a realistic target range might be more like $35 to $40 in the medium term, modest upside, but potentially solid.
So assessing the discount at $28.88.
It trades below our estimated intrinsic value, $35, and well below average analyst targets, $45.90. Suggests a modest discount currently. Makes it an appealing entry point if you believe the bull thesis, providing a reasonable margin of safety for a long-term hold. Compared to peers like Sprinkler, Braze's growth is better, though margins lag. That suggests upside potential if execution continues, especially on costs. But expect volatility. That beta of 1.2 means it moves a bit more than the market. The bull case, supported by Mizuho, really argues for holding 2-3 years for the profit story to play out.
Are there fundamental principles giving investors an edge here?
Several. The founder-led structure aligns incentives. Magnuson and Hyman's wealth is tied to the stock. The predictable SaaS model, 80-90% recurring revenue, inherently reduces risk, and investing heavily in AI positions them perfectly for long-term secular trends.
Any potential hidden advantages, asymmetric information?
Possibly in those partnerships, like Shopify. The market might be underestimating how quickly that could unlock e-commerce growth. That could be an edge.
So what should investors monitor closely?
Upcoming Q2 2026 results are key. Look for concrete signs of margin improvement and smooth OfferFit integration. Those will be crucial signals for hitting that 2027 profitability target.
Okay, let's bring it all together. Answering that central question, Braze's path to profitability.
It really is a delicate balancing act, isn't it? Impressive revenue growth versus the crucial need for operational efficiency. They're addressing it with specific strategic moves.
They hit non-GAAP profitability, but GAAP is still the goal.
Right. Non-GAAP profit in Q2 2024 was a milestone. But GAAP profitability, with that negative 20% net margin currently, remains the target. The losses stem from aggressive R&D and sales investments.
What's the roadmap to get to GAAP profit?
Several key initiatives. 1. Keep scaling that predictable subscription revenue, 80-90% of income. 2. Diligently reduce cash burn. Remember that 10% year-over-year reduction in Q3 2025. Keep that going. 3. Skillfully leverage economies of scale as the customer count grows. Hit 1,770 in 2025.
How do OfferFit and Shopify help profitability?
They're expected to boost margins by improving the ROI for client campaigns. Better client results should support higher retention and potentially higher subscription fees for Braze down the line.
So what's the projected timeline for GAAP profitability?
Analysts generally project Braze achieving full GAAP profitability by 2027, with free cash flow potentially turning positive even sooner, maybe in 2026, estimated around $50 million.
What does that timeline mean for you, the investor?
It suggests patience is required, a 2-3 year horizon to potentially see meaningful returns based on profitability. But you have to acknowledge the risks, competition, regulations that could delay that timeline.
Why the confidence in that 2027 timeline? What's the logic?
It stems from that predictable revenue model and the steadily improving margins. The 68% gross margin shows underlying efficiency. The current operating losses, native at 15%, are a direct result of choosing to invest aggressively in growth.
And leadership is focused on balancing growth and cost.
Seems so. The focus on AI and enterprise sales, bringing in Ed McDonnell, aims to accelerate revenue while keeping tighter cost controls. And client results, like Viber's 50% conversion lift, show the platform delivers real value, supporting retention and growth.
But we need to mention the risks again.
Absolutely. You have to be aware of the 61 risk factors detailed in their earnings reports, privacy rules, intense competition. These could delay profitability if not managed effectively.
Does their financial position help them navigate these?
Yes. That strong foundation, low debt, 0.1 debt to equity, that large $500 million cash reserve provides a robust buffer to navigate challenges, making the 2027 target seem realistic, though not guaranteed.
So what does this all mean for you, the potential investor right now?
It means Braze represents a compelling growth stock, but one with a clear, albeit patient, path to profitability. At $28.88, it trades at a discount to estimated intrinsic value, $35, offering that margin of safety.
The high PE reflects growth expectations.
Yes, the PE of 60 is high, pricing in strong growth. But the 26% revenue growth and 117% net retention arguably justify a premium for long-term holders.
We've really charted Braze's journey today. Leadership, platform, financials, future path.
The path to profitability by 2027 seems credible, driven by scalable revenue, AI innovation, increasing financial discipline.
So a compelling opportunity, potentially at a favorable price.
Potentially, yes. But patience and that long-term perspective are absolutely essential here. This isn't a get-rich-quick stock.
Okay, one final thought to leave you with. As this kind of personalization technology becomes even more sophisticated, more seamlessly woven into our daily lives, what are the broader implications for consumer behavior, for brand loyalty, maybe over the next decade?
That's a big question. How might companies, even individuals like ourselves, need to adapt as this tech becomes even more deeply ingrained in how we interact, how we shop, how we consume information?
Think about how that evolving landscape could shape your own investment decisions and maybe even just the way you engage with brands moving forward.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.